Good evening, and welcome back to the latest edition of the InvestTalk market analysis for the week ending December 20th, 2024. Appreciate you all tuning in and liking and subscribing to this video. I am host of InvestTalk, Justin Klein, and my title for this video this week is Volatility Comes Early for Holiday Investors. And this is the heat map for the last week of the S&P 500. And what you can see is only a handful of names really eked out a gain. Big sell-off on the Fed news and a more hawkish Fed, and that really brought some volatility early. Typically, it's the time when volatility is fairly light. You typically get a float up. Bring up the S&P here before I get into the data. This is the weekly chart, and what you see here on the daily is a nice sell-off in the last 3 days. That was the Fed day. You had a little bit of a follow-through on Thursday, and then you had a bounce, but a fade on Friday. And overall, the market was overbought. It did need to come in, and pretty big buying, pretty big volume on the buy side coming in on Friday. And that was certainly of note. And even on the small caps, you look at the Qs here, you see pretty good volume there as well. So what that tells me is probably near term, you're probably going to get probably an okay market into year end, probably through the first week of next year. And typically, this is a time outside of some major news event like a Fed announcement. This is a period where there's light volume and it tends to float up. People are mainly focused on the holidays, and they don't really make big positioning, especially big positioning changes, especially when a lot of those trades could trigger taxable gains. And so that's why you typically get the market floating higher. There are also some structural issues with, not issues, but dynamics with long dated options leaps that expire in December and January, and that typically creates gamma hedging, which means that the dealers are buying the underlying and kind of supporting the market, which is kind of how this whole machine works. And so it was a bit surprising to see a little volatility early. So I'll dig into the charts a little bit more in a second, but let's get to the economic numbers. Retail sales did come up 3.8% in November. That still remains solid. The consumer is on solid footing. Building permits did tick up a little bit to 1.5 million. Nothing wrong there. The current account balance, though, in Q3, that did tick down to negative $310 billion. And that is going to be a negative to GDP in the third quarter and this quarter. And what that's kind of showing is our companies front loading a lot of their importing from overseas to avoid tariffs. I think that certainly could be happening as well. So that might be a drag on the economy in the first couple of quarters of next year and even this fourth quarter. So just to understand there's some dynamics there with potential tariffs coming from the new Trump administration. The continued claims for unemployment insurance that ticked down, but is still in an uptrend. So the jobs market is not great, but not terrible either, and it still kind of remains in that phase. Existing home sales did tick up in November. That was interesting as well, even though rates went up. So there's a lot of demand for homes. It's just a matter of how many are coming on market. And what you can see here is inventory. Inventory has been on the rise. It's now in an uptrend. Now it's not even close to a level where there's too much inventory and prices are going to fall dramatically. No, we're still in a relatively tight housing market, so don't think that is going to change. Then the inflation front, this came in on Friday. You saw the PCE tick up a little bit, and we do think inflation has bottomed, probably heading closer to 3%, which is one of the reasons why the Fed, I think, is looking to not cut very much more, right? Maybe one or two times next year, maybe not at all. And so that's why the market reacted so negatively on Wednesday. Now let's go back to the broad indices. Actually, let's go to the NYSE. I think that's always the most educational because it's a much broader index, 2,500 stocks versus 500 for the S&P. And this just had a healthy pullback, kind of like we had in August, right? We had that sell-off in July, which didn't really affect too much in the market, affect the NASDAQ more than affect the NYSE. But this is just a fine pullback. No real issues here overall. What else did we get? You have the gold miners did sell off, but if you look at the junior miners versus the developed miners, that remains an uptrend. So that's telling you that maybe the sell-off in gold, which get to that chart here, is a bit overblown. What's interesting about the gold price is we didn't even fall below the November lows. So this is called an H pattern, and H patterns with a higher low are typically very bullish. And so as long as we don't breach the November lows, this is going to be very good for the gold market, despite the breakdown or not the breakdown, but the further pullback in the miners. Look at the dollar. I think this is that's a strong move for the dollar. And what did gold do? It barely pulled back. I think the relative strength here is just outstanding on just gold price. Obviously, the miner is certainly weaker than you would expect. So that is of note, but definitely a mixed bag in the gold market. I'm still leaning medium term, long term bullish, but obviously near term some troubles in the precious metal space. And a lot of it has to do with this, which is bonds sold off over the past couple of weeks, so rates are on the rise once again. And I think the market's realizing inflation's bottom. They're not going to get many rate cuts from here, and so I think you're going to get a choppier period for bonds overall. Let's get to the MOVE index. This will be something I will be watching. If the Fed is no longer easing their policy rates, they're not being as accommodative, the dollar strengthening, that is negative for the liquidity in the bond market. So if this starts to bottom here, then that could be a worry for the markets. But we're still a ways away from levels that are worrisome. I think this needs to get back above, probably here 120, 125 for it to be something to really worry about in a big way. Here's the growth to value trade. This was surprising to me. Let's see if it holds. It is a higher high, so you have to take note of that. It's still in this broader uptrend. But I'll be very interested to see if this has any follow through to the upside. Here's the weekly chart. You are getting a MACD divergence, and I think that if the dollar can top, this will certainly be a potential top for the growth of value trade. But we'll certainly be on the watch for that. Look at the bond market, the credit markets. Here's short-term junk to short-term treasuries. This had a move down, but you can see as this happens, right, there'll be aggressive sell-offs, but overall it's still in a broader uptrend. That means the credit spreads are tight, and there isn't a worry of a major drawdown major default cycle ahead. And as long as there's none of that, then it's hard to have a major pullback in the equity markets as a whole. There's the NASDAQ, COMPQ, also nice bounce on Friday. So we'll see where this goes. This is an interesting time. Like I said, I think we do have a light volume float higher into year end and probably the first week of January. You had that one catalyst. You don't really have many catalysts going forward with all the holidays and not much economic news. There's nothing really to drive the market, I think, lower into year end, to be honest with you. And so I expect kind of a choppy to upwards bias for the next week or two. So that's kind of my take for now. Yeah, I think that will close it out. There's really not much more to say because it's probably a boring market for the next couple of weeks. So just to understand those dynamics, don't get too caught up in it. This is a time to kind of reposition your portfolio, reassess your portfolio as we head into 2025, because it'll be a different market than this. I think it's going to be a very different market, closer to maybe 2022. Maybe not as negative as that, but certainly choppy with major sell-offs, much higher volatility overall is kind of what I'm expecting. And we'll see if we get a breakout in volatility in the new year. I suspect we do sometime in the first quarter. All right, that about does it. Reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.